Hey, it's Thomas here. By now, most of you should have finished your tax filing already. Did you have to write a check back to CRA? Or did you get some tax refund back? Because in this video, I'm going to talk about 9 ways that you can generate more tax return in Canada. So trust me, you don't want to miss out. Oh, and if this is your first time here, welcome. This channel is to help Canadians to make better choices on retirement, wealth, and insurance. My goal is to make sure you can take 1 or 2 ideas home and start making better financial decisions today. If you find value in this video, consider subscribing. Let's get started.
Now, you might be asking, why should I think about this now since I already done my tax return? And here's the truth. CRA is the house and the house always wins, and the only thing you can fight this is time. Most of the tax saving strategies requires a longer period of time to exercise, so don't wait until the last minute to learn how you can save more taxes. And before we get started, always the disclaimer first. I'm not an accountant. This is not a video encouraging you to DIY your tax filing or a video giving you tax advice. This is a video highlighting tax deduction area that you might want to know, so make sure you do your own due diligence and talk to a professional accountant to see what other areas may apply to you when it comes to generating more tax return. If you want to learn more about how tax filing works in Canada, I have a video on that too for you to check it out. And let's dive in. I will start with the home office deduction first, and a new temporary flat rate method that was introduced in 2020 due to the pandemic. Now, keep in mind this one could be different for next year, but seeing how this year is currently going and with so many Canadians working from home still, we should expect that there might be a benefit again for next year. The new temporary flat rate method lets you claim $2 a day for each day you work from home with a maximum of $400 or 200 working days, and assuming you work a 9 to 5 jobs and 5 days a week. To qualify for this benefit, you must have worked from home due to the COVID-19, or your employer had required you to do so. You must have worked from home for more than 50% of the time for at least 4 consecutive weeks, and any expenses you're claiming must have been used for work-related reasons during this period. With the flat rate method, you don't need to calculate the size of your workspace, or you don't need to keep supporting documents or submit the Form T2200. There's also a detailed method for home office deduction too, which allows you to claim the actual amount that you pay, such as electricity, heat, water, home internet access, rent, maintenance, and minor repair costs. If you are considered a commissioned employee, you can also claim home insurance, property tax, lease of equipment like a cell phone, computer, laptop, tablets, or any item that is related to your earning commission income. And to qualify for that, your employer must provide you with a complete and signed form of T2200S or Form T2200. Keep in mind there are some limitations as well, so be sure to check the CRA sites for the most up-to-date information on the limitations. But if you think you will want to go down this route, make sure you keep all your receipts for records. You won't need to submit it when filing your taxes, but you will need to keep it for at least 6 years in the case you are audited. The second way to get more tax return in Canada is to contribute it to your RRSP or Registered Retirement Savings Plan. I talk a lot about RRSPs here on my channel, so be sure to check out some of my other videos on this topic, but I can't stress enough how your RRSP is a great way to lower down your tax bills. And that also means a larger tax return in April to a normal 9 to 5 employee. Your contribution limit is 18% of your earned income from the last tax year, and you can carry over any unused amount from the previous years. A common question is what tax bracket is high enough to make contributing to your RRSP worthwhile. There are many layers of tax brackets that include both provincial and federal, but I always keep things simple, so I would suggest to break it down into 3 tiers. The first tier is an annual income up to about $40,000. In this tier, doing RRSP may not impact that much. Maybe it's more beneficial to do tax-free saving. The second tier is between $40,000 to $80,000. If you have extra cash flow that you can put aside, then RRSP is a great place to save. And the third tier is an annual income above $80,000, and you definitely want to look into the RRSP. Let me give you an example on how it impacts your taxes. if you earn $70,000 a year, you can expect to pay $13,000 in tax plus CPP and EI. However, if you put $10,000 into your RRSP, you will now reduce your taxable income to $60,000, and therefore your tax bracket will drop to 16%, so you're paying around $9,600 instead, saving you $3,000, and that's almost a month of take-home paycheck already. But what if you max out your RRSP already and you still want extra tax deduction? Then you can use the line 22100 carrying charge and interest expense to help. There are a few things you can use to deduct your taxable income. What's the most interesting one is when you borrow money to invest, as long as the investment yield interest and dividends, 100% of the interest is taxable write-off. So for example, today say you borrow $100,000 from the bank and invest in the stock market. With today's borrowing interest rate is still sitting at 3 to 4%, which means each year you're paying $3,000 to $4,000 a year. That interest is 100% fully write-off, just like putting into the RRSP. And if the investment is doing well, say 8%, you get $8,000, double of what you initially put in. So if you use the strategy right, this not only help you to reduce your tax, but at the same time, it can boost your rate of return as well. But please, make sure you seek out for help to see if you qualify for this investment loan strategy, and I also have a video for more details. Be sure to check it out. The fourth benefit to generate more tax return is for those with children, allowing you to claim up to $8,000 for kids under 7 years old and up to $5,000 for kids between 7 to 16 years old. Childcare expenses are eligible to claim include daycare, summer camp, nannies, and etc. Be sure to save these receipts throughout the year. You will need to file your tax each year if you'd like to get benefits like the GST HST credits and the Canada Child Benefits or CCB2. The GST HST credit is not just for those with children. You're eligible if you're a Canadian resident and must be at least 19 years old or older. You have a spouse or common law and you're a parent who lives with the child. In addition, it's for those with low to moderate income. For singles, you must make less than around $47,000 before tax, or if you're married, your annual net income must be less than $62,700. The next benefit are medical expenses that you can claim was non-refundable tax credits. However, the eligible amount is 3% of your net income or the set max for the tax year, whichever option is less. For example, in 2020, the set max was $23,097. Eligible expenses include dental, laser surgery, private insurance premiums, and more, and you will be required to keep all your receipts and prescriptions. You can also claim expenses for you, your spouse, common law partners, or children under the age of 18. For example, if Tom's net income is $60,000, the 3% threshold is $1,800. If Tom spends $1,200 for laser eye surgery in April, he will not be able to claim the expenses. However, Tom decides to go to physio, which costs him another $1,000, so he can claim both his eye surgery and his physio now. You might be surprised how this can help you to treat yourself with the pre-tax money. Another benefit is vehicle expenses, but only if you're self-employed or use your car for your business. Then you are able to claim expenses like your gas, insurance, license, maintenance, and more. If you also use your car for personal use, you can only write off the portion you use for your business. You'll need to keep the record for your mileage, dates, and the purpose of your trip. If you're lazy, you can use an app to track it, and I'll put the link below too. You'll need to also keep your receipts throughout the years. And by the way, if you're a business owner, I can share another line strategies to help you to reduce your corporate tax. Just reach out to me if you're interested. The next benefit is interest paid on student loans, which is obviously eligible to those who are or were students. However, there are few restrictions. You can only claim interest payments on loans received under recognized student loan program, and you cannot claim the interest on loans from anywhere elsewhere, even if they are used towards your education. This claim is considered as a non-refundable tax credit. That means it can lower down your tax bills, but you do not receive a tax refund. You can also carry forward your student loan interest for up to 5 years, so you can be strategically with it by saving the claims for a year when you might owe taxes. Another overlooked tax deductions are charitable and political donations. These can add up in a year if you're making donations here or there to different organizations. You can receive a 15% credit on the first 200 of donations that you made, which is equivalent to $30, and a 29% credits on donations above $200, up to a max of 75% of your income for the year. Keep in mind, you will need a tax receipt from the charitable organization. You're also able to receive tax credits for any donations you make to federal or provincial political parties and candidates too. The next overlooked tax deduction is moving expenses. You can claim this if you have to move to work or run a business, or you need to move because you need to study as a full-time student enrolled in a post-secondary program, and you need to move at least 40 kilometers closer to your new work or school. Some of the eligible expenses include transportation and storage costs, travel expenses, temporary living expenses up to 15 days, cost of canceling the lease, or cost of selling and buying your home, and more. Similar to the home office expenses, there are two calculation methods for this claim, with one simplified method and a detailed method. Oh, and let me give you one more as a bonus. You can also reduce your tax bills with employment expenses like professional association fees, union fees, membership fees, and insurance premiums that are related to your profession, or expenses that you may have to pay for your employment income, like your cell phone bills, supplies, and more. For expenses like those, it must be in your employment contract that states you need them for your work, but your employer does not provide you with allowance for them. There are also other benefits for certain professions, like transportation employees, forestry, trade people, or artists. So be sure to talk to your accountant to see if you can claim any of those. As you can tell, these are dedicated for each Canadian's personal tax. Pretty much everyone in Canada can use at least half of the list. Question is, did you really look into it? Or at least talk to the accountant about it? Because this can give you thousands of dollars in tax return. Alright, I hope you enjoyed this video. If you have any questions, please leave them in the comments below. This is Thomas, and I will see you in the next video.